Hey everyone, in this video we're going to be looking at Chapter 11 and working through the workbook exercises here, or just the exercises I should say, on practice with feedback spreadsheet. And as per usual, I am going to skip the first tab and then move on to the next one. And in this chapter specifically, we're going to be looking at equity accounts, common stock, dividends, things of that nature. And also, sorry, you got a message to send back to a student there. Looking at some of the balance sheet accounts in the shareholders equity section, treasury stock, etc., and how those kind of show up, and some of the descriptions as well as far as shares authorized, issued, outstanding, etc. Okay, so let's start with March 1st. So we have your company. We issued 800 shares of preferred stock, excuse me, and received a total of $6,400. So when we're talking about receiving the cash, that's going to be the total amount that we get. So as per usual, our assets of cash go up. And then we want to look at the par value here. And remember, we're talking about preferred stock in this example. We'll look at common stock in the next one. And so when we want our credit, so we have the preferred stock, and then we also have, and that will be at the par value, but we have the additional value associated with the stock issuance that's above the par value amount. So here we can find the right account. We want to see preferred, paid in capital excess of the par. And so the par then is just the number of shares times the $1 par value per share, and then we can just take the difference there to get our total of the paid in capital amount. Because remember that the par value is really just an arbitrary number assigned to the value of the stock when it's issued, and it doesn't relate to the actual market value, which is what the value of the stock is in this instance as far as selling, the cash received essentially. Okay, and then on on May 8th we had a similar situation, so very similar type of transaction. I think it's 100,000. So we want to put, the total amount of cash we received is the cash that we want to reflect, and then we're going to have common stock, very similar to the transaction above, but that's going to be common stock instead of preferred, and then the same type of account, the paid in capital excess par, but using common versus the preferred here because we're talking about two different types of stock. So in this instance, we have $2, or let's do it similar to the other one, 4,000 shares times $2 per share, the par value, and then we just take the difference to get the paid in excess amount. Okay, then on July 5th, we declared a dividend of 50 cents per share on the common stock. It's issued 40,000 shares, authorized 120,000, and 20,000 shares are outstanding. Okay, so now we want to do our stock issuance, and so when we are declaring a dividend, we're basically going to be recording the amount payable at that point, and so we're going to want to put the payable similar to what you'd have for any other payable, right? Accounts payable, so on and so forth. I'm not sure what this is, kind of a funny extra account in there, so I think that's just ignore that piece of it. It usually should just be a 2-line journal entry. And then the amount that we're declaring that's going to be the dividend then is going to be, so we've got 50 cents times 20,000 shares outstanding, and then you just debits equal credits, right? So the amount that what we're saying here is we're going to pay this dividend. And remember, a dividend is just a distribution of retained earnings, basically, that the company has amassed over time. And so, like, if another way to think of that, kind of the company's savings over time, right, that it has held on to, now it's sending some of that savings back to the owners, essentially, through the payment of the dividend. And we haven't paid it yet. Let's come down here and we'll actually, okay, that's a different one. So it's not going to actually even go into the payment of this specific dividend, but we can see here on 12/1, we're paying dividends declared last year. And so this is there was a different amount, different declaration previously that's not captured in this problem specifically, but this is similar to what the outcome of that transaction would eventually look like, where the cash is actually paid out. But let's account for this middle transaction here, that we purchased back 600 shares of our own common stock, paying a total of $18,000. And so, again, remember, when we're talking about stock buybacks, we have this new type of account that we want to identify, and that's called treasury stock. And this is going to be a contra equity account. So similar to the contra assets that we've seen, we've seen accumulated depreciation. We've seen the allowance for doubtful accounts. There's a variety of contra accounts, contra assets in those instances that reduce asset value. And that's why we record those, is in order to record an estimated net amount of AR, for example, or the net book value of a depreciated asset. But in this instance, we're going to be recording a contra equity account. And so, again, it's not that there is a contra asset in this instance, but instead it's a contra equity account. And so there'll be a reduction in the outstanding shares, and that's where you kind of find the difference here. So we have issuance of 40,000 and 20,000 outstanding, and so the difference, the issued shares are shares that all historically over time there had been 40,000, but then we bought back 20,000 because there's only 20,000 left. And here it looks like we're purchasing back 600 more. And again, it told us how much we were paying. So really, to record this transaction, you just need to know the treasury stock contra equity account, which will, in essence, reduce the stockholders or shareholders' equity balance in total. Again, we bought back the stock, which is, I think that kind of logically makes sense, because the increase in the common stock is when we issue it in the first place. So when we buy it back, we have cash going out, and we have a reduction in that original issuance. It's just kind of housed in two separate buckets. So you don't reduce common stock directly. You record that purchased back stock in a separate account called treasury stock. Okay, so here we have a multi-step income statement and classified balance sheet, etc. I'm going to leave this one for you all to work on as well. The way is just drop downs essentially, and actually I want you all to practice this, because you will see some examples of situations or a problem similar to this on the final exam. I'll do a couple, just to show you real quickly. I think you all are probably pretty familiar with the whole process for doing income statements and balance sheets, etc. And so you just go through and pick out the numbers here are kind of just input as examples, so you don't have to worry about inputting any numbers specifically, but you just need to put the titles of the line items on the individual financial reports. Okay, let's take a look here at another problem with equity accounts. And so again, nothing too exciting here, very similar to what we saw last time. We have the issuance of common stock. So again, when we issue common stock, right, we're receiving cash in exchange for stock or ownership percentage of the business, and just a little bit different than the first problem where we had preferred stock first, but now we're doing common stock first. And just to show you real, just to do the accounts real quick. Preferred stock and just to touch briefly on, what is preferred stock versus common stock. They're essentially different types of, let's see how best to explain this. Different types of stock. Common stock typically comes with voting rights, and the preferred stock does not have voting rights, so you get less of a say in how the significant objectives are carried out. Certain high level significant corporate decisions, you would not have a say in those, because it is an ownership percentage of the company with common stock, or voting rights. Preferred stock usually has higher priority in terms of dividends. So if you are if the company has, they call it dividends in arrears. So maybe the company has not paid out the dividends for a period of time, but then they do come to pay out dividends, then the preferred stock gets paid first. Different things like the liquidation priority and the price volatility are also kind of components. So nothing you need to be too worried about understanding, but just know that these are two different types of stock, and the preferred stock is kind of a unique one that has less to do with voting rights and, as far as kind of the owner voting rights, etc. It's a little, but the payments are a little more assured. I think a good way to think of it is the preferred stock is kind of more of a hybrid between common stock and bonds, as far as compared to common stock being that traditional ownership of the company, etc. Okay, so with that said, again, not too important for our purposes in this class this semester to have a great, super detailed understanding of the differences there, but you should be aware of the general differences in those two things. Okay, so now I'm just doing the journal entries here. It tells us how much we received. Again, the par value times the shares gives us the amount to be recorded into the specific preferred stock and common stock account, and then everything over that goes into the paid and capital excess accounts. And then we've got the payment of dividends, and so it tells us that we paid dividends from last year. So again, this is just kind of your traditional payable is debited to decrease it, cash is credited to decrease it, and it tells us what the amount was. Okay, so that was payment of a prior year dividend. This is declaration of a current year dividend to be paid the next year. And so in this instance, here we were decreasing our payable. In this instance, we are recording a payable with the offset to retained earnings. And we have to calculate the amount here. So it's 0.75 per share. And we have 81,000 shares outstanding. So the amount of the dividends will be that based on that formula. And then we had a stock buyback type situation. So again, we use the contra equity account treasury stock, and we credit cash. And what was the total? 45,000, I think. Yeah, it just told us what the amount was there. So, basically the same journal entries from the second tab, so nothing to get too excited about there. Okay, so let's look at some ratios for this chapter. So we have gross profit. We've been doing this one for a long time. So remember, that's going to be our net sales. I don't think I can link. Let me just make sure I can. Yeah, no, it doesn't let us link into those. So net sales minus cost of goods sold. And then net income then is going to remove from that amount the operating expenses to reduce gross profit by our OPEX, operating expenses. Okay, and then looking at our earnings per share ratio, you can see the kind of the breakdown below. One thing to note in this specific problem, assume no preferred dividends paid. So here we would need to take into account our preferred dividends being subtracted from net income, but we don't have any. So we're just going to do our 2,400, or actually we can just link two equal signs. Net income divided by our average shares outstanding of 1,000. Average shares outstanding 1044. And then 960. And then we've got the next ratio here for us is our dividends. Oh, geez. Let's see. I can do a formula, right? So we have 1,200 divided by 1,000. So dividends per share, nothing too hard with these. 6.6 with these ratios. You just have to find the right numbers, to be dividing basically, but nothing complex. So just put those in. 1382.4 divided by 960. Okay, so now let's go through and get our gross margin ratio. So we take our gross profit divided by our net sales to figure out how much of our net sales we're actually keeping. So gross profit, what is our profit margin, in other words, after accounting for our cost of goods sold. Sometimes it does a weird thing there if you don't put the formula in just right. Now, what am I doing? Okay. Oh, whoops, I'm getting distracted here. Okay, gross profit divided by net sales. There we go. And then profit margin ratio is going to be very similar. Actually, I think I can just drag this down. Yep, because that's just going to move it to net income. So here we're talking about net income. So again, gross margin ratio, how much is our profit after accounting for cost of goods sold? And then the profit margin ratio is more along the lines of how much is our operating expense eating up? How efficient are we basically in terms of our operations? Perfect. Okay. So from this point, let's move down to our price earnings ratio, or PE ratio. And this ratio is essentially a formula that can tell us is a stock a good deal, right? Is if it's a low price to equity ratio, it can indicate that there's that the stock is undervalued, or a high ratio could indicate that there's a high potential of future growth, or that just in general the stock is overvalued. So to calculate our PE ratio, we're going to take our market price per share, and I think it says here, stock price per share, divided by earnings per share, and we have that number there. So our stock price per share divided by our earnings per share gets us 50. And what we're saying with that, it means that essentially that the investors are willing to pay $50 for every $1 of earnings then, basically. Right, because the earnings per share is 240, but the stock price per share is 120. So 50x the earnings per share, essentially. So similarly with, I'm just going to drag this across and then we'll update the ratio. So not 120, but 80 there, and then not, the third one is 60 stock price. So as you can see, the P ratio, price earnings ratio, just continues to get higher. And so maybe the stock is overvalued, but also it's kind of an indication that that the stock or the company might have expectations of high future growth. So investors are, it's an attractive stock, to investors, in other words. Okay, and then finally we're going to look at our dividend yield ratio. And in terms of our dividend yield ratio, we're basically looking at how much a company is going to pay out in dividends each year relative to the stock price. Basically the returns that an investor was going to get from the act, just from dividends, essentially, right? So if we say that there was 1,200, see, it does a weird thing. Let me put it as, starts doing a percentages, kind of messes up. So 1,200 dividends to common stockholders, but we want to see per share. Do we have dividends? Oh, we have dividends. Yeah, sorry, dividends per share is right there. So dividends per share divided by the market price per share. So here we've got, let's see if this will work. I can stretch that formula over and we'll just update to the changed market price. Stock price 60 on that one. And so essentially what we're saying in this ratio is like what is the return that you're earning from the dividends. So if you buy the stock at the price that we see it listed for here, $60, your return on this one, for example, in this year or in this year, would be 1% just from the dividends alone. So it's not necessarily taking into account the stock appreciation or changes in the market value of the stock necessarily, but solely from the dividends. So here, it's $1.20 of dividends per share, but each share costs $120. So it's 1% return, relatively low return, but that's just from the dividends alone is what we're looking at there. And what's the why do we care as far as that goes? Certain investors want high dividends. That's something that they look for. If they're focusing on income generation from a specific dividend stock, etc., as opposed to just market appreciation in the value of the company. I'm trying to think of other reasons we really can kind of be concerned about the dividend yield. This is kind of being driven by the stock price being so high. So if the dividend yield increases to a very high amount, like above average, then that could potentially indicate that the stock price has dropped a bunch, and maybe that is related to fears about the company, so on and so forth. So just things to think about, but the ratios aren't too complicated there, but that's what they generally indicate. Okay, so here is our gross margin ratio, better than the industry average at 42%. Looks like it is. Here's the averages there. Is our profit margin better than 15%? Yep, looks like we're better than 15% on the profit margin. Is the dividend yield better? No. We're under, under 3% in each year we looked at. And does your PE ratio indicate greater growth expectation than the industry average of 25? Yeah, that's what we're looking at there, right? So it's up to, again, it can be overvalued. Maybe there's some sort of speculation going on, but also it could indicate expectations of future growth, right? All right, let's look at the next tab here. I think I'm going to leave this one for you all. We did the 2 and 3 tab, or sorry, 2 and 4, and both those are extremely similar to what we have here. So I don't think there's anything new to add other than what I've already shown. Another multi-step income statement, classified balance sheet problem. So those are good practice. I'll leave that up to you all. And yeah, another similar problem. So chapter 11 is pretty quick. I don't think it's too technical or complicated. Hopefully the concepts are making sense. The kinds of journal entries that you record really are pretty basic. There's not a whole lot of differences going on. Just do kind of the same sorts of transactions. This one is just, again, you just have to figure out the right, if you look back here, just figure out if you want a reference point for that problem, come back to this tab and kind of match up the transactions to the different types, whether we're doing treasury stock, purchases, dividend payments, issuances of stock here, and declarations of dividends. So yeah, all very similar. I think you kind of saw that in class. We got through these in-class problems relatively quickly. So kind of a good chapter to have towards the end of the semester as we're hopefully coming in for a soft landing and not trying to overburden ourselves with too much technical information as we sort of wrap up the semester. So so I'll leave the rest of these blank. Like I said, you can refer back to the earlier work to go through those. And I think with that said, actually, though, I am going to look back here. Let's see. Okay. I will, with that said, I'll work through one of these with you just because I think this might be helpful for some of you if you are getting stuck on some of these problems. And since there is a separate multi-step income statement, et cetera, similar problem, I'll leave this one blank, but let's step back to number 3. And I'll work through this with you just to help out anyone who might be stuck on any portion or have a question as you go. So our first part, we're just going through and calculating the same old net sales, that we learned earlier in the chapter, earlier in the semester, I should say. Here, we're going to calculate our gross profit by taking out our cost of goods sold. Okay. And then we're going to account for our operating expenses. And I think, what did it say? Okay, I don't think these have to be in any specific order, but let's look through. And I'm actually kind of curious. Okay, I guess it doesn't really matter which accounts you choose as long as you pick kind of the right ones that would fall into that category. So as we look through and just select different types of operating expenses, you'll see the X's go away essentially. Even if they don't, I think you can switch these around because there's no way that I know specifically that I'm looking at insurance expenses 42, is the accurate expense amount. But I think the way this problem's set up, we can just kind of go through and select anything that would fall into. So rent expense, remember, would fall as an operating expense. Rent revenue is typically in the other section. So let's see, what have we not accounted for yet? Catering expense, insurance expense, interest expense will go in the other section as well. Loss on sale will go in the other section. Operating expenses, that'll be that was our selection at the top. So what is left? Let's see. Supplies expense, and then total operating expense will be at the bottom. So that looks like the last two, I believe, there. Oh, no, we have one more. Warranty expense? Okay, yeah, we didn't include that one yet. Okay, so there we have all the expenses, and then we can go through and say, total operating expenses is that amount. This gives us operating income. And then, like I mentioned here, this is our other gains, losses, revenues, and expenses. And in this section, again, we're going to have things like gain on sale. I guess this one we will need to line up, positives and negatives to things that are positive and negative on net income. So the gain will be positive, like a revenue, and then interest expense will be negative. Maybe rent revenue, if we have that listed. Typically rent revenue, unless it's a company that primary business is rental income is a primary source of operation, primary operations source of revenue, but typically it's more ancillary, just kind of maybe a company had a spare building or something, or maybe they rented out an office location in one of their buildings or something of that nature. So it's not their primary core, function of the business there. Some other things, loss on sale, they have a negative. And let's keep looking through. What are we missing? Oh, I think that's I want to say, no, there must be one more. Okay, what do we have? Gain, interest, income, possibly. Yeah, interest revenue. And then we can say total other. So it's got a little bit of a different name than typically you would see it with the exact same name, but total other works in this instance. And then we've got income before taxes here. Pre-tax net income. Well, then we'll have tax expense. Sometimes you'll see, I know sometimes in these problems there is tax expense broken out. Sometimes there's not. So in a real situation, you typically will always have a line item for tax expense, but sometimes that's excluded from some of these, textbook problems. Okay, then we're down to our retained earnings statement. And so we always start with beginning retained earnings, and then we have our net income. Here you can see those numbers match up. So beginning plus net income, if I can find it, there we go, less dividends. Again, if I can find it, and that will give us ending retained earnings. Awesome. Okay, at least the first three must be in order of liquidity. So the first three are always the easiest to tell. So cash, accounts receivable. Oh, I didn't like accounts receivable. What was before? Maybe prepaids? Typically, I always assume that, well, what's more? Oh, petty cash, maybe? Really got to kind of poke through these. This whole drop down to it was not receivables. We had cash. Sorry, bear with me as I just work through these. Why do we have? Wait, was that cash that we selected? Yeah, and then accounts receivable. It didn't like that. So accounts receivable it wants to be third. Maybe supplies. No. Short-term investments? Oh, okay. We really don't know exactly what I would put accounts receivable typically is more liquid than short-term investments, but I don't know. I guess this problem has a little bit different. So, those things of this nature, always cash and AR are going to be very liquid. Then prepaids, things of that nature that are going to be inventory, supplies, stuff like that is going to be also very liquid and very current types of assets. So I just got to go through and find those things. I wonder if it does. Okay, maybe we're still trying to put us in order of liquidity because it didn't like that as it was. It didn't like supplies as it was. So it must be prepaids. No, it didn't like prepaids. Oh, sorry. Usually remember we have our contract asset of allowance for doubtful accounts, and that will fall. And I should have known that because it has a negative right here. So anytime you see a negative amount in the asset section, that's going to be a contra asset essentially. So that will need to be listed out, with the negative and right under the AR there. Okay, now back to what we were talking about. Inventory, things like prepaids. And then I think supplies is our other current asset there. Very good. As far as long-term investments go, we've got a notes receivable. What else do we have? Sometimes we'll see land held for speculation. Speculation refers to the act of hoping that it increases in value to sell in the future, investing in it essentially. Okay, as far as plant asset goes, we've got things like buildings. And remember, again, the drop down kind of covers that up too, so be careful there. But anytime you see a negative, remember that's going to be our contra asset of accumulated depreciation when we're talking about plant assets. And there's just that one accumulated account. So what else do we have? We have equipment with no depreciation on it. Now land, this is the speculation land, but this is land actually used, in the business. Okay, and machinery, yeah, we haven't used that yet. Okay, now we're down to intangibles, and that will be things like goodwill, franchise, patent, copyright. Did we get patent? It probably has a patent in here. Yep. And what else? Franchise, goodwill. Okay, we got those. Oh, trademark. Yeah, that's another example. Okay, so that's all the different kinds of, again, the only ones that need to be in a specific order are the first three here, but you do have to watch out for the contra assets. And we're going to see some other contra accounts down here. Comp bonds discount there, I can tell you already. And then this will be treasury stock. And that's the new one we just learned about. So you can see it's a contra equity, so it has a negative impact on shareholders' equity overall. And then, as I mentioned, this will be our bond payable, looks like, and then we have a discount on bond payable showing. And maybe a note payable, other long-term, liability, note payable. As far as accounts payable, typically always first. I don't think it's going to force us to have our current liabilities in a specific order necessarily. So we'll just look through and see, okay, there's an estimated warranty liability. Maybe we have taxes payables one, wage payable maybe, unearned revenue. Don't mix that one up with revenue, remember, or accounts receivable. I see that a lot. Remember, unearned revenue is a liability. One more. Not seeing those. Sales tax payable? Oh, yeah. Okay. We had federal taxes and a sales tax payable amount there. And we know that this is not premium on bond payable because it is a negative amount in the balance there. Okay, now down into equity, which is really the focus of this chapter. So all these accounts that we just learned about, we have common stock, we have preferred stock, we have the two that we learned about here, paid in capital. That one's the common stock version, and then preferred. And we have retained earnings, which, oh yeah, I might have just accidentally got that in the right spot. So it should match up, 1309. So 1309, yep, we got that matched up. Some of these, it doesn't matter exactly if you have it in this, perfect location as far as drop downs, but that one does because those amounts actually refer back to the calculated total, like 1309 and then 1309 you can see here. And I know we got all our X's to go away, but just to highlight, what you need to compare here. So this is our total liabilities, our total equity. So you add those together. That's 4844. And then you can compare that to total assets of 4844. So those match up. Everything balances. The numbers here, were already put in for us. So that, I guess, wouldn't have really ever been off. But I just wanted to highlight that for you all when you're working on test problems or homework problems that you know, kind of how to do that. And then remember, it's the basic accounting equation, assets equal liabilities plus equity. All right, well, hopefully that was helpful. Again, there's this, I will leave this one open for you to work on, and you can refer back to my work there. Hopefully that will be helpful. I think this is a good practice to go through to try to identify what's in the specific line items. And you might need premium on bonds payable, just a little hint there because that one is positive. Whereas we saw in our example here, it was negative. So that's probably going to be, premium on bond payable. Just trying to pick out any hints here. Depreciation, remember, that needs to go there. Allowance for doubtful accounts would go here. Those are those contra asset accounts. And yeah, I'll let you have some fun with this problem. And hopefully this video is helpful. Like I said, very similar in terms of the journal entries, so you can kind of just copy the work off there. You've got lots of examples to finish these problems out. And as far as the ratios go, just, have a general understanding of what the ratios indicate. Typically, we're not going to be asking you to recalculate from memory. If there is a problem on the exam where you will need to know a certain ratio, I'll try to highlight that for you so that you can remember the specifics, but definitely understand the logic of what these ratios indicate and just sort of what they're used for, I think is the most important thing to be able to take away, because it's so easy to, look on ask Siri or something how to calculate a ratio. These aren't complicated ratios, but knowing how to use them and what they represent, that's where the real value comes in for you as a student, and like as an investor or a finance person really was what the career expectation or, career usage of these different types of metrics, or as a business owner too, as you're looking at performance, but if you're your company or benchmarking, etc. So, all right. Well, thanks everybody. I hope this video is helpful and hope you all are having a good one, and I'll talk to you soon. All right. Thanks. Bye.